How did investment banking expand globally through history? Imagine a world where money moves faster than ships crossing oceans, connecting distant lands and fueling growth. That's how investment banking grew across the globe. It all started with international trade. In the late 1800s, banks like the Hong Kong and Shanghai Banking Corporation expanded into Asia, Europe, and North America. They financed exports of tea, silk, cotton, and sugar. These banks also helped build infrastructure like railroads and ports, which made trade easier and more profitable. By the year 1875, HSBC had branches in Yokohama, Calcutta, and Manila, making it a key player in Asian trade finance. Despite global conflicts like the First and Second World Wars and economic downturns like the Great Depression, investment banks kept growing. They survived by focusing on their core strengths and maintaining reserves. After the First World War, new branches opened in booming cities such as Bangkok and Shanghai, showing confidence in emerging markets. In the United States, investment banking began during the Civil War, mainly to finance government needs. Later, the New Deal reforms in the 1930s separated investment banking from retail banking, creating independent firms. After the Second World War, economic policies supported corporate growth, mergers, and increased financing, which helped the industry expand further. The late 1900s brought big changes. Deregulation and globalization played major roles. Laws like the Glass-Steagall Act were gradually repealed, allowing banks to combine retail and investment services. This led to the rise of large financial groups like Citigroup, which could now offer a full range of banking services worldwide. Investment banks also expanded by opening offices in key financial centers. Goldman Sachs, for example, opened its first securities subsidiary in Japan in 1991. As Western Europe moved toward a single market, firms expanded into London, which became a hub for international mergers and stock offerings. Advances in technology, especially computers and telecommunications, made it easier to execute trades and handle complex transactions across borders. This shift from traditional dealmaking to trading and proprietary strategies increased profits and connected markets worldwide. In recent years, smaller boutique firms have emerged, focusing on specific industries or transaction types. These specialized firms now compete alongside larger banks, showing how diverse and sophisticated the global investment banking scene has become. In summary, investment banking grew across the world by financing trade and infrastructure in the 1800s, weathering global conflicts and economic changes in the 1900s, and then expanding rapidly with deregulation, technological progress, and strategic international moves in the late 20th and early 21st centuries. This growth helped shape the flow of capital, support corporate expansion, and drive financial innovation worldwide.